Thank you so much for joining our session today. Again, this is Blockchain Series. This time we are going to be speaking about decentralized finance or DeFi. As news analysts and reports are coming into our inbox, we thought this would be time to address what DeFi is about and give a primer to all of you who are interested to learn. As you know, we believe that disruption is constant. And as we look to bring businesses with great potential to our platform, we keep a close eye on trends and what areas and sectors are hot in the market. So just a little bit about me. I'm Sandra Ford, an operating partner here at Republic, manage investor relations and portfolio company relations. And we have been putting on these webinars now for 6 or so months, and I see a lot of familiar faces. Thank you again for joining today. In terms of disclaimer that we have to tell you about, this presentation is for educational and discussion purposes only. Nothing herein should be construed as investment, legal, tax, or accounting advice. Always do your own due diligence and consult with your advisors. Investments on Republic are subject to total loss of principal. Now, this session today on DeFi is going to be merely educational. We are not supporting any of the businesses that we are going to be discussing, but it's going to be a really good overarching discussion about the DeFi landscape. So just to kick off, I want to talk about a little bit of what exactly is DeFi. So after the bull market in 2017, the crypto market has really kind of gone through a roller coaster ride. If you remember, Bitcoin traded back in 2017 over $18,000, while dropped to 4,000, and now it's back at 10,000. Quite volatile market. But when you take a closer look at the market and what's driving the uptick in the crypto market specifically, you see that some of the emerging players are coming from decentralized finance and addressing what is new in finance. Look at Chainlink, for example, ticker symbol LINK, that essentially connects smart contracts with payments. And essentially since last year, they are 5x, while Land, which is Aave, the ticker symbol Land's market cap went from 5 million last year to 671 million as of this morning. They are essentially enable people to earn interest on deposits on borrowed assets, crypto assets. So why is the DeFi market soaring? Well, our speakers are going to give you a lot of insight about these emerging trends, and I'm really looking forward to hearing them give their nuggets of knowledge and share it with you. But before we start, I would love to ask you, how come you joined today? What specifically about the blockchain space interests you, or about DeFi? So I would love to hear you all drop your thoughts and questions and reasons why interested in blockchain, why you're here today. Melody, you are excited to learn. We love to hear that. Love the global presence. Elaine, security, very important aspect. Disrupting the financial markets. Yes, absolutely. Michael, you want to learn the key components of the ecosystem. Great. We are so glad you're here. Well, with that, thank you again for joining. And we are going to kick it off today. So Alex, take it away.
Awesome. And thanks, Sandra. Welcome, everybody. Great to see so many names from all across the board. Today, my colleague Graham and I will be speaking on first the orientation and overview of how DeFi sort of came to be or has been in its development. And Graham will go into a lot more deeper specific examples featuring some projects in the space. Now, brief background on myself. I'm a partner here at Republic, and I lead the investments advisory arm for our crypto team, or Republic Advisory. Previously, I came from the traditional VC world, starting at a fund of funds, and then moving on to a private equity firm where I helped grow out their U.S. venture practice. Republic was the first deal I diligenced and closed, and now I'm excited to be here to explain some of the frontiers of decentralized finance. And with that, I'll let my colleague Graham introduce himself.
Hello, everybody. As mentioned, Alex and I work together on the advisory department in Republic. As a result, we are engaged very closely with a variety of companies across the spectrum in the crypto or decentralized world. This is everything from older 2017 sort of protocol layers onto decentralized finance applications, companies as well, all the way through to government bodies that are looking at centralized digital currencies, things like that. So we're just excited to bring the exposure that we get and distill it down to something easily digestible and entertaining for our clients. Alex, I'm going to pass it off to kick off.
Awesome. And give me the next slide, Graham. All right. So a lot of you on this call, I'm sure, are already familiar with the understanding of what the financial markets look like, what the ecosystem looks like, and what our national economy looks like. So here there are some key functions we all need to be able to do, right? One is to be able to print money, set target interest rates, in essence, monetary policy. As well as establish trusted intermediaries to keep our money safe, to assist and make sure our transactions go through on a trusted basis. And those might be commercial banks, investment banks, and the sort. And then in obviously more recent times, we have any of the fintech giants you might be well aware of already, like PayPal, Affirm, Square, all in their sort of niches under the umbrella. So in the same sense that the world of traditional finance is an umbrella of an umbrella of terms, decentralized finance is really going to be the same. And in its vision, it might not look exactly like what we have today, but it certainly has to start with some of those functions it wants to disrupt. So with that, let's sort of just take a quick visualization of what that difference means. So in a centralized world, right, you guys are all familiar, right? If we're doing a credit card transaction, it's Visa, American Express, making sure those transactions go through and are logged on their own database. Or if it's with a bank, they're the ones who are amassing capital and lending it out to you or to companies, and then being able to generate some sort of profit on that. So in a decentralized world, it's really an experiment to see which parts of these financial mechanisms can we take out some intermediaries for and give more of a cut to the end-to-end participants. And in that sense, that's going to be just the overarching theme if you're looking for a sort of visual on what these decentralized applications will be talking about going forward. So like I said, DeFi is a lot of things, but you will hear some different, jargon or different language around it. It's highly community driven. So you'll hear a lot of things about community governance. You'll hear about, trustless transactions. But then you'll also hear a lot of familiar terms like loaning and interest rates. But at the same time, something's new, like what does it mean to stake or to have bonding curves? All of these are some, crypto economic jargon, but ultimately tie back to fundamental use cases from the traditional financial world. And that goes all the way up to even, secondary markets and trading. So with that, I'm going to go ahead and give you guys, a brief history of how DeFi has been developing and how it's sort of led to this newest wave and hype that we see today. So for any of you who have been following the crypto and blockchain world, say maybe since 2017, if you ask anybody in the 2 years, 18 and 19, what was the biggest problem we had? It was probably going to be liquidity from most educated folks. And what does that really mean? That fundamentally means that for our crypto native assets, we had a hard time being able to translate them or see real world value to them. In some senses, we had been able to figure out how to bring real world assets into the crypto space, thereby, making some sort of a bridge, and something even us at Republic have been working on. But I think the crypto world in general still had the problem with how do we get crypto native assets to be linked to some kind of cash flow, some kind of dividends to bring back to its initial investors. So I would say that set the stage for this development, liquidity. So traditional centralized markets, what did that really mean in the beginning? So as we tried to work with a lot of these crypto native assets, you had the rise of regional monopolies because of the regulatory oversight you saw in those different regions. So doesn't matter if you were in Asia or in North America, typically the more capitalized and the firms with the most friends in the regulatory world were able to move the fastest and provide an easy, familiar, digestible solution to handle these cryptocurrencies. And that largely was hinged on their ability to work with fiat currency through their licensees to transact with cryptocurrencies on their platforms. That was great in terms of getting the word out and getting wallets in each other's hands. But what it led to, if you're familiar with some examples like Binance and Huobi, some of the major exchanges over in Asia, and then say Kraken, Gemini, Coinbase here in North America, there's essentially a price gouging trend going on, right? Because they're the only ones with the proper recognition, reputation, and licensees to operate. They're also the ones who have the optionality to charge the most, given that there wasn't necessarily significant competitors at that point. In that world, however, there's obviously, as a sort of partially efficient market would hold, going to be some kind of disruption in order to bring down those prices again. So now we go into what decentralized finance, right? It's about creating not just regular technologies we've seen already and then adopting them to cryptocurrencies, but rather to go from the ground up and build a new technological framework to handle cryptocurrency on a crypto to crypto basis. So I mentioned previously, liquidity. How did decentralized finance work on this? And it's actually not something that happened overnight. One of the major forays decentralized finance has been working on is stablecoins, or AKA, as the name sort of alludes to, a cryptocurrency whose value is stable and typically pegged to a US dollar for reference. And in that way, as soon as we got stablecoins or built enough trust for them, we did find a way to have a form of pseudo liquidity so that we can transact crypto to crypto as opposed to needing to always do fiat to crypto. And that was one of the biggest changes that set the framework for building applications on top of it, AKA the flow of capital. So now with that first layer established, that's when DeFi applications were able to tap into this sort of pseudo liquidity. And this is not too different from how the traditional world of finance and economies developed. In the traditional world, as soon as we figure out how to keep capital flowing, then we're already thinking about how can we store it, how can we lend it, how can we park it in different assets, trade those assets. And so in the earliest stages of DeFi, you'll hear a lot of those similar words. Some of the major ones include lending and staking, AKA how can I take the opportunity cost of my capital and put it somewhere else and then make an interest on it, make a profit on it later. And then second, because there isn't necessarily centralized financial institutions here, how can we establish a world of reputation so that we can ultimately trust, right? Ultimately trust who we're borrowing from and who we're lending to. And so in that sense, it's going to follow a lot of the parallels of traditional finance, but not necessarily to a T. And with that, let's go ahead and dig into the specific applications, some of the biggest projects going on right now. And I'll pass that back to Graham.
Great. Thank you so much. Let's kick into a little bit of the space. Again, why is DeFi so popular amongst users, right? If you're going to create an application or a company, this is obviously something that you need to cater to and make sure that you have a very good relationship with the user base. DeFi's popularity now comes down to a couple reasons. One of the biggest ones is that in the rise of 2017 and subsequently a variety of companies have launched, investors have obviously gone into them and have been sitting on a decent sized bag of investments that, until that company really proves its worth or they decide to exit the position, there's really not much to do there. One of the biggest advantages that DeFi has put forward is that you can now lend these assets that you've just been sitting on and holding and actually provide them as liquidity for trades, as Alex mentioned, and in return get yield. This has proven to be really amazing in a very low yield environment in the traditional space, and just a fantastic way to earn recurring revenue, right? They're assets you already have. You may as well make some money by putting your money to work. Aside from that, assets can also be traded directly from your cold wallets or your Web3 wallets. So what does this mean? Again, crypto and decentralization and all of these concepts, they really come down to trustlessness. One of the biggest problems with using an exchange is that you actually have to send those assets that you hold off to a custodian. Technically, they hold your private keys. They actually are in full ownership of those assets. You're relying on them to give them back to you at the end of the day. That trust could be broken. You're also paying fees to move money there, to transact between different currencies. And all of those fees go to these exchanges, right? It's not really a community-based thing. They're a massive gatekeeper, and they do have a strong barrier there. So there's a lot of interest on the user side, why to participate. Obviously, if you're rewarding participants, that's very good in and of itself, and that as a participant, you are seeking said rewards. Now, on the other side of this equation, there's plenty of benefits for builders. Again, one of the biggest barriers to going to market to launch is actually getting listed on an exchange. This is something that I deal with very closely for our clients over at Republic. After launching their token, after running their event or their sale, I should say, they then need to go liquid, provide all of their investors with an opportunity to trade. The current platforms, as Alex had mentioned, are sitting on top of regulatory compliance and have proven to be pretty arduous gatekeepers to this liquidity that we're all pursuing. As a result, there have been very enormous or egregious costs, maybe really specific hoops that are sort of strange, whether that be providing a certain amount of your fundraise as a liquidity cushion, or having to actually change the format of the token economics that you've developed to fit within the criteria that they demand. Either way, it's just created a real disparity between, well, power dynamics, right? And the projects are now very much at the behest of the exchanges. On the flip side, these decentralized exchanges support any asset that's built on a certain network. I would say for the sake of this example, we're mostly looking at Ethereum, also known as the world computer. It's where a lot of these things are being built. And any decentralized exchange or DEX that's built on Ethereum can simply, you can upload an asset and there you go, it's tradable. Now, it's obviously deeper than that. There needs to be something to trade against, right? So if I just upload my asset and people try to sell it, there's nothing on the other end to make that market work. So companies are able to provide liquidity and create a cushion and ultimately build their own market. One of the most interesting things is that companies throughout 2020 have actually realized that in incentivizing those users to bring their liquidity and facilitate these trades, they can also handle user acquisition and grow their own product, right? It's really a win-win and truly has been wild to watch, very fun. Some of the key barriers to this space are really just the technology. I would say aside from that, it's quite easy. So what we have here is MetaMask, Nifty Wallet, Coinbase Wallet. These are all what we call Web3 wallets. Basically, let's stick with Ethereum. Any Ethereum-based asset can simply sit on these wallets. They can access your cold storage, so the thing that you have in your safe at home or your safety deposit box. They can sit on your browser as an extension. They can even be on your phone as a web wallet. And as a result, whenever you do interact with one of these new platforms or companies, these decentralized applications built on Ethereum, all it does is ping your wallet. You connect your wallet directly to it. And in the same way, you put a like on Facebook, and Facebook is actually receiving the monetary benefit of your information. Placing a like on a decentralized Facebook might just take a micropayment from, let's say, your MetaMask account. And once you have one of these wallets up and running, it's really as simple as clicking unlock wallet or engage, and you're up and running, and you are connected to these companies. So in really thinking how to present this to you, obviously we've given a bit of a robust breakdown, but I personally believe there's nothing easier than just direct exposure to some of the products. So let's go on a quick review and look at what's been built And it's really important to know that these are each layers upon each other and have actually folded their functionality back in on each other. So it's been truly wonderful to watch. There's tons of community engagement as well as synergies between a lot of these projects as well. The beginning of our construction and our dive into decentralized finance does start with the stablecoin. This is something that was actually tackled in a centralized fashion back in 2017 when traders were realizing, especially on the Bitfinex exchange, that buying and selling Bitcoins to US dollars is very arduous. You have to enter and exit the ecosystem many times. Banks have charges for that. As a result, we got USDT. The T represents tether. 1 USDT is tethered to $1. It maintains that peg in a very simple fashion. They say, hey, we've got a giant vault in the back room, and for every USDT we have a single dollar bill. Now, this was completely centralized and obviously raised a ton of concerns around appropriate auditing, trust around the company Bitfinex to manage these tethers. And actually, as they began to mint more and more, it began to clog the Ethereum blockchain. So there's a bunch of fascinating elements around this. But of course, we're here to talk about decentralized finance, and having a centralized stablecoin at the core of all this is just disconcerting. So the first major attempt at cracking this nut was MakerDAO. A DAO is a decentralized autonomous organization. I would essentially call it a social group linked up through Discord or something to that effect that places their votes on chain. Maker uses Ethereum. So again, they come together, they have a governance structure, people can organize, and all decisions have to be voted on, and those votes execute automatically. Now, the way Maker came to facilitate a fully autonomous version of a peg, maintaining that 1-to-1 ratio with a dollar, is what is considered a collateralized debt position, AKA you're putting some of your collateral into a debt to issue this stable asset called DAI. As a result, they know that collateral is a variety of cryptos, so it's a little bit dangerous, and therefore the ratio of what you must put in to what you can get has to be 150%, right? It needs some wiggle room to move up and down, considering that crypto markets are all over the place. MakerDAO has been the first attempt. I would say it was very successful. Holding your money in DAI, the stable asset, actually had pretty fantastic returns in terms of yield. However, in March 12th, 13th, that Thursday, Black Thursday, when the markets crashed, Maker took a pretty substantial hit and actually had trouble maintaining that peg. So it's been very interesting. They've actually brought in some of those centralized stablecoins as collateral, which is a bit of a head scratcher to the community, but obviously it reinforces their product. A response to this has been a variety of projects. I have reserve here, but there are so many attempts at gamifying, some gambling attempts. Just how do we maintain a dollar? We can do it through a variety of crazy algorithmic functions. We can do it through gamification. We can do it through arbitrage. Reserve tried to take the central bank model, a little bit ironic, and apply it to a full-blown algorithm. So it is attempting to expand or contract its economy algorithmically, so fully automatically based on the price, and that is its attempt. Again, there's many versions now at this point. Stablecoins are being issued pretty constantly. I would say the market share is as big as the sum total of the monies in the world, and we're actually seeing the rise of central bank digital currencies, which are essentially large-scale stablecoins issued directly from governments. Now, the stablecoin is at the basis, right? We start to build from there. We now have a metric of exchange that we can trust, and we all understand $1 to $1. I can move between that. From there, we've begun to build into more complex instruments. And the DeFi space has really exploded in this regard. So it's opened up the ability for short positions, leverage trading. Liquidity aggregation has been really interesting because it turns out when the users are the people providing those sets of assets, those pools of liquidity, not only is liquidity aggregation getting a trade platform into your ecosystem, but it's also user acquisition. So really fascinating, and there's been quite a bit of gamification around that. Flash loans are another concept. When we get algorithmic, I could make a loan that facilitates a very specific execution, almost like an application level. And the flash means it happens like that. So you actually create the loan, it executes, you receive your capital back. Some of the first instruments to release was Synthetics, one of the early stage companies. And basically they took that maker model of using collateral to issue a stable currency in a different format. So what this does is instead of issuing a stable coin off of your assets, you know, a one-to-one peg, it said, I will give you the same amount of value that you put in, but in a different cryptocurrency. So if you look at our little example on the right, it says SUSD as the counterpair, that's their stable coin. But there's also SBTC, which means a synthetic Bitcoin, or SETH, a synthetic Ethereum. And what this really does is open up the space. Let's say you're sitting on a fat stash of Bitcoin, but somebody else has this application that requires Ethereum to use. And you're saying, I would love to get in there. I would love to play with it, make some of the yields, but I don't want to give up my initial Bitcoin position. Then I can put the Bitcoins onto Synthetics and actually get a similar value of synthetic Ethereum. Very similar is Compound. Again, these companies are popping up and they do rely off each other, but Compound is very much a lending protocol in a similar way where you can actually take stores of assets and transfer them into a different crypto asset without completely losing your exposure to the underlying asset. So again, if you really want to participate in some of this stuff, a lot of them could be games that rely on some far out concept like, cryptocurrency, maybe 0x, which is another exchange, very interesting. It's a wonderful project in its own right, but I don't own a lot of it. So if I'm required to own some 0x, I could go in here and actually take out a loan on that crypto. And this really begins to build into an ecosystem where we can access a much broader variety of functionalities without having to give up on our true long-term holds. Now, as we begin to get a little bit farther, a lot of these liquidity campaigns, in order to say, hey guys, we want you to bring your assets to us. What does that do? That really allows people to trade. So let's say I put up Gram token onto a market and people want to sell it. There obviously needs to be something to sell into. That early attempt became people putting up large pools of Gram tokens mixed with large pools of stablecoins on the other side. However, depending on market demand, maybe Gram tokens all get dumped and we're now just sitting on my 50-50 pool is very heavy on the stable coins because nobody wants my token. Full shame for me, but it's not really functional if we're trying to do price discovery, right? A lot of people buy these tokens up front and then sell them immediately. Balancer allows you to put into an algorithm saying, I'm going to provide these pools. I want to always maintain that there is 75% more stable coins to Gram tokens, and the algorithm will always look to reshuffle these by actually going out into the various decentralized exchanges and just making sure that there is balance in the force. It's very interesting. It's quite essential for price discovery, which again is a very hard thing to do. You've released these assets to investors. Nowadays there is a platform, but it's usually very beta, right? So how do we know the true value of our full-grown ecosystem, and how do we make sure that we're not just getting fully dumped on upon the initial release? Balancer is a very interesting way to make sure that there is an active market and it stays alive. This really all builds into Uniswap, which was one of the holy grails, a decentralized exchange. They've been around for a very long time, but they've always had the problem of liquidity, meaning if I took my asset to a DEX and I said, hey, I'm selling it, there would be nobody on the other end to greet me. So a sale does not happen. It's very slow. It doesn't match the trades very well. And it's really just been rough. That's one of the reasons the decentralized exchanges have not taken off, is that when you look at that compared to say a Binance or a Kraken, where I can just say, I want to sell this asset, place my order, and boom, it's sold, waiting 2-3 days to try to find the counterpair, pretty brutal. So Uniswap actually came out. It's extremely easy. Those Web3 wallets that we already discussed, you go to the Uniswap website, you click your wallet, and you see this little teeny form that we have here. It's as simple as that. You pick an asset, you pick another asset, and you just say, I want to convert one to the other. And boom, it stays in your wallet. It's all automatic. Again, I could take it out of my safe. I could plug it into the computer, make the trade, put it back, and everything is still in the safety of my home. And again, those private keys have never left my ownership. This is hugely important. Uniswap has actually been quite the success. They even are now issuing a token of their own where you get to contribute on the governance and actually make decisions about the growth of the platform. I will not say lightly that the governance positions on all of these is a small feat. The people that are participating in these are very active. Basically, they buy a certain token that is almost like a share, and then you do get to, like a board member, actually make decisions on the movement of these companies. So it's quite fascinating, both from a financial level as well as governance. All of this, of course, comes with a good deal of risk. One of the most interesting things about the decentralized finance is that these yields have been insane. So they're basically saying, hey, bring us your funds. We will pay you a ridiculous amount of interest in order to do this. Now, the risk being, some of these are wildly experimental. Some of these are contracts that maybe have not been fully audited yet, AKA high risk, translates to high reward. So people have been rushing into these things, trying to get that yield. They're playing games like maybe the first week gives you 10x yield. And that's a way to bring users to you immediately, right? It's really fascinating. But again, the risk appetite gets a little nerve-wracking. So we have Nexus Mutual, sort of the apex of one of our DeFi players right now, which offers insurance. This one actually does require KYC, unlike a lot of decentralized finance. They are kind of coming back to some of the trusted centralized players, but it does offer you a capacity to take out a loaned asset and have insurance against it. So if everything goes wrong, you have some coverage. Now, obviously, due to the high risk, it's quite expensive. But again, these instruments do build on top of each other. And if I have an insured chunk of assets, then maybe I can take higher risks and experiment with some of the other platforms that we've covered. Now, all of that, those are just a couple examples, but I would say there's some more foundational ones, and they've been tried and true. But the future of DeFi is growing so quickly. I cannot even stress this. I literally go to bed and wake up to 2 or 3 new projects. I would say the learning curve is enormous. So if there's one thing I can get you to do is to activate your curiosity. Basically, if you can find people to follow on Twitter, or if you set a Google alert for DeFi, you'll probably be getting a daily torrent of information. I would say the insiders in the industry all consider themselves pretty savvy with legal technology, et cetera. Everyone's been exhausted just trying to absorb the wealth of information coming in and the rapid growth. It's truly phenomenal. I would actually say that some of the most influential developers and CEOs of companies are actually being based off of their speed to deliver products. So unlike 2017, where it was white paper investments and nothing tangible, we're actually seeing a lot of engageable applications being released. And again, engagement is why this is so exciting. We've been sitting with these cryptos. We haven't gotten to the true utility. And suddenly they're saying, hey, come to this application, engage, and you'll earn rewards for a certain reason. Beyond that, due to the gamified elements, there's a bunch of exciting drama that's unfolded. We recently had Uniswap, which is an open sourced application, again, really powerful. Somebody woke up and after a week they forked it and told all of the liquidity providers, hey, come to our platform. We'll give you 10x the amount of rewards for a limited period. And they essentially attacked it from the liquidity side. It was fascinating to watch. $800 million to 1 billion actually moved between these two platforms. And the community really had an interesting time coming to terms with themselves. How do we deal with ethics? How do we also support companies that are putting in good work? And truly, you know, we're in a place where all sorts of experimentation is is occurring. We're seeing art being folded in, where people are creating marketplaces for art that can have a token peg, so ownership, non-fungible tokens, as well as all sorts of communities that are rallying together to support endeavors. And basically, all of that is to be said that there is just an enormous explosion of development. And while a ton of it is very gambly or scammy, I would say without a doubt, we are going to see, as the dust settles, the ones that stand and prove their worth will absolutely become the foundational layers of the next financial industry. So with that being said, I just hope that you take away excitement and curiosity, because this is just a huge learning curve. So with that, I will pass it back to my team, I believe either Sandra or Brian, and we would absolutely love to hear a little bit from our community here. I know we covered a ton, so any questions that we can answer, if you want to type them in or ask them directly.
Thank you so much, Graham, Alex, and Brian. This was a wealth of information, definitely a lot of takeaways, and I feel for me, I'm going to do some research on these companies, and we'll check out your blog about DeFi and what's coming there next. I popped in already the blog link into the chat, but maybe Brian, you can do that one more time. And just want to thank you all for joining our session on this particular episode of Blockchain Education. Again, we have had Blockchain 101, 201, we had a masterclass on blockchain. So we really believe in this space and we keep a close eye on it. And we just really super appreciate that you joined. And again, thank you for your time. I will send a follow-up to all of you with some additional resources. And again, thank you everyone, and you all have a great day.
Thanks everyone.
Thanks everybody.